This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Patrick, I want to move on now to our post-game chart book, which you've titled Betting on the Tail Move in Oil. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads. Patrick, before we dive into crude oil, we've got the S&P 500 chart on page 2. What's going on here?
Well, you know what? We always want to have a quick look at this chart, and you were specifically referencing that very bullish price action that we've been seeing. And there's no denying that the last month that has more or less seen a 500-point advance in the S&P has been a very bullish advance. The one thing I reflect upon is that during bear market rallies are always the most violent and the most convincing. You know, you take several of the prior bear markets, a 20% rally off of their oversold levels is actually incredibly common. And we're just approaching, 15 to 20% off of that recent low. I think it's very premature to be already suggesting that this is a bull market just because we've bounced after a 6-month bear. I think that there's a lot more price action development that we need to see before I flip to the other side. And in fact, as we go into the post-Labor Day period and the market gets active again, and I think there's lots of potential headwinds that could cause this market to come right back down. The one thing, though, Eric, that I wanted to move on to page 3 is just the volatility. And Charlie really nailed this. I mean, ultimately, what we saw was just a perfect oversold condition. CTAs were short. Volatility targeting asset managers basically were massively underinvested. All these different things were set up, including dealers being short all sorts of contracts to hedge out their books. Suddenly, you had an unwinding, and it created this reverse impulse. And so as volatility collapsed here on the VIX, that has been driving a lot of buying. But we are now approaching the bottom end of the range of the post-COVID period. I mean, the VIX is more or less, at some points we've seen it come down to like the 15 level. But this 18 to 20 range where we're slowly approaching has been a bottom end of this range that could be where volatility settles in. The interesting thing about that is that it's just that volatility will no longer be a tailwind, but rather become more neutral. And when you already have CTA flips and gamma neutralizing, the bigger question is what will drive any further buying in the markets. And this is where I think that the market could run out of gas. And that doesn't mean it has to be immediately some bearish decline, but rather simply that the market starts to consolidate at these levels. And that'll be one of the more interesting things to see whether that happens throughout the remainder of the summer.
Well, Patrick, moving on to page 4, we've got crude oil futures definitely in a strong downtrend, or at least has been. Maybe we're seeing some signs of bottoming here. Maybe not. What do you think?
Well, listen, we have guest after guest come on that really suggests that there's a secular trend in the conditions there for oil prices to be considerably higher over the long term. So what we're in the midst of is a short-term correction from quite an overbought condition where sentiment was so decisively bullish that we were due for some sort of a pullback. So now that we've pulled back, I think the theme that me and you discussed about talking about was, well, how do you put on during this kind of a period some right tail trades that just in case crude oil goes ripping higher and let's say by year's end doubles in value, how do you put on some low cost, low risk trades that could have a big payoff if it works. So I want to spend some time talking about some potential ways to put on trades like this. And I think technically, when we're just looking at charts on page 4 and 5, the observation there is simply there has been a very distinct and deep retracement of the prior advance, and we're just going to have to wait to see when the bulls re-engage a new bullish breakout. Obviously, I think the easiest thing to do is simply use the 100 level as a pivot. I mean, if we are clearing $100 on the upside on crude, then it's really going to start demonstrating some technical strength and accumulation that could create that feedback loop that starts a new bull trend. So we'll see whether or not the bulls can start clearing some of these hurdles. So, Eric, just on page 5, I have the weekly chart on crude. And what I wanted to do is set up context for what the type of trades that we're looking at setting up with the options trade is this idea that, well, crude had this great run, but if there was going to be another move on the upside, the crude oil hitting 150 or even $190 on the upside, while it seems like a stretch, is not impossible. And certainly putting on some low-cost option trades to be playing that upside melt up is an interesting way of putting it on without being loaded up on all sorts of Delta One positions at the money.
Patrick, that's exactly right. And the way I think about this is, that blue arrow you've got, it's coming at some point. The question is whether there's a red arrow that's not drawn on page 5 that comes first, where we go down to $60 before we go up to $160. And of course, if you were just to buy crude oil futures hand over fist here, thinking, oh boy, 200-day moving average, this has got to be the bottom. If you load up on them and then we go down another $20 from here, that could get really painful. So the question is, how do you structure the trade for maximum upside while minimizing your downside risk? Because let's face it, we do have a recession coming, and it's going to result in some demand destruction. So I'm not sure what the next few months brings, but I think the blue arrow comes sooner or later, and I don't want to miss it. So that's really what's on my mind. How do we put the trades on in order to not miss the blue arrow, but not be exposed to maybe another 10 or $20 of downside, depending on what happens with the recession?
So, Eric, that was exactly what I was thinking in terms of putting on some different options trades. So what I did here was I just first put up some charts just to size up the crude oil markets in terms of the options. And then we can certainly take a look at what kind of combinations you could put on to put some of that upside gamma, just in case the market did have a big rip. Now, on page 6, I just have the January 2023 crude oil implied volatility. Just wanted to highlight that while volatility is high, when you look at relative to the average range that the implied volatility has been in the post-Ukraine period, we are trading towards the bottom end of this range. So right now, volatility has somewhat normalized. We're not getting these, we're not going up in the 55, 65% ranges where we have seen short-term spikes go up to. So right away, there isn't a crazy cost for buying upside gamma straight out, but I tend not to like to have that heavy of a theta burn just buying at the money calls. So this is where we can kind of talk about some of the different types of strategies you could put on to play that upside. Also, just on page 7, I will just put that implied volatility relative to its 30-day realized historical volatility. And you can see that while it is a rich vol premium, it's not that far from where the actual realized volatility has been. And so I think options right now in the crude oil market are very reasonably priced to be putting on all sorts of these types of strategies. The other thing that I highlight on page 8, which is the skew, what is interesting is what you have, which is almost like a very typical equity style skew, that big fat left tail, right? So volatility premiums on put options are very expensive when you're going out of the money, particularly to $50 or less on the downside going for the rest of the year. But what is interesting is the skew stays relatively flat for any move in crude oil up even $30 before it starts to steepen upwards. And so there's lots of room to get very reasonable option premiums without paying up any big pickup on right tail upside until you start getting to some pretty high levels on the upside.
Patrick, let's talk about the different trading strategies. The most obvious one is just buying calls. But despite what you've said about implied volatility and realized volatility tracking reasonably close, they're still both really high, and that means you're paying a lot for those calls. Are there better strategies that we can use in order to get that upside without paying through the nose for volatility?
Eric, let's put some context to this. First of all, let's build a scenario. And the scenario is our hypothetical investor is already positioned in energy, whether directly through the futures contracts or whether through the equity markets, but they already have a certain amount of exposure. But what they're looking for is to put on a trade that if crude oil suddenly started ripping, some catalyst became evident and crude oil starts heading straight up, and we're suddenly heading all the way out to $120, $150. How do you put on some options trades that are incredibly low cost, that under the circumstances, if that happen, have extraordinary payoffs? And yet, on balance of probabilities, if crude oil doesn't make that move, you don't lose a lot. You're just putting on some almost right tail insurance on a really big crude oil move. And so the strategies that typically reduce cost, the most traditional and basic strategy is a very clean and traditional debit spread, which is essentially buying a call option and simply choosing a higher strike call option to sell. What you're essentially doing is reducing your deltas, but reducing cost. Your theta burn goes down. You neutralize volatility risks, all sorts of different things, and you're making a very clean directional bet as to the upside move. So let's start with on page 10, I put up an options chain with $25 strike increments on the 159-day option going out into the new year. And what I wanted to do is basically think about the idea that, well, listen, what if crude just ripped and went to a fresh high? It was beating $125 on the upside, and you wanted to have some sort of a play with a debit spread on that crude oil will make a fresh new high this year and head towards 150. Well, you could right now open, let's say, a 125, 150 bull call spread just over $1. And which pays off $25 if you're right about crude oil busting through the 150 level on the upside by the new year. And so you can immediately put on just a very modest cost debit spread and have the play that gives you a full participation if crude oil was to make that break to new highs.
Okay, Patrick, so in the debit spread or bull call spread scenario, what we're talking about is basically making a small bet that's going to have a big payoff, but that big payoff doesn't come until we get to $125 on crude oil price. So we've got to have a really big move up in order for it to pay off at all, but we're able to get that upside, $25 of potential upside for about $1 of cost. So this is the lottery ticket trade, I would think. What are the other ways of approaching this?
Well, I mean, there's lots of lottery ticket trades. In fact, this is where I want to talk about the ratio callback spread. And what I want to talk about here is the scenario where our investor that we're using as an example wants to buy an options trade or put on an options trade that gives them huge upside gamma if they're right about an explosive move in crude oil happening this year. And this strategy involves the selling of one closer at the money call. In this case, let's say we're going to use the January $100 strike call, which is trading just over $6. I'm rounding these numbers, and uses the proceeds of the $6 credit to buy the $125 strike call options, which are trading for roughly about $2 a call. And so you would buy 3 times as many of the call options with the credit. So you're long that much more of the out of the money gamma. Now, this is a strategy that is done at a zero cost, but it doesn't have a zero cost carry. You have the margin being calculated very similar to a credit spread, where the spread between the two strikes has to be put aside as collateral. But from a cost perspective, this options trade is done at a zero cost. Now, this is one of these strategies where if you're a little bit right and crude oil goes up just a bit, you're going to lose some money. What you're looking for is that extraordinary right tail move where crude oil in this calendar year is going to be exploding north of $125 with some upside momentum. If that happens, this is one of these strategies that has all of that upside right tail open for you, and you make lots of money if there's that big explosive move. But if you're just a little bit right, that's where the danger zone is for this trade.
Well, Patrick, because of the recession that is oncoming, it's that danger zone that concerns me the most, because I think there is a scenario here, Patrick, where even in the face of recession, crude oil prices continue to drift slightly higher because more and more people figure out what David Hay and Adam Rosenzweig and I have already figured out, which is we're at the early stages of an energy crisis, and it's going to get worse with time. But the thing is, until this recession plays out, we're going to continue to see decreasing demand. I think there's plenty of room to not go beyond 125 right away. And this trade really loses money significantly. If you get as far as 124, but not quite to 125, you've lost a few bucks. How about the butterfly spread? How does that one work?
Well, the butterfly spread is a very interesting way to have an alternative to the debit spread that has a really big payoff on the upside. And with the feature of the butterfly, very similar to the debit spread, is that the trade can be put on for just a debit. Like you don't need to come up with any big heavy margin or anything. And so it's very low cost to buy that upside right tail insurance for an explosive move. Now, I want to give an extreme example of, let's say you believe that there was going to be an extraordinary move if some scenario happened. And even though your existing portfolio of long equities and crude oil plays and energy stocks was going to benefit, you wanted to have some sort of payoff that would be extraordinary if that big move happened. And so as an example, if you, let's say, did up to the end of the year, a butterfly spread between 150, 175, and 200, you can pretty much open that combination for 20 cents. Now, let me just step back and explain the butterfly. It is essentially, the easiest way to think about it is that it's marrying a debit and a credit spread together, where you're short the 175 calls, but you're long the 150 and the 200 call. And this can be put on very cheap, like you're saying, 20 cents. And if for whatever reason crude oil started ripping anywhere up towards 150 to 175, you could have that 20 cents turning into $25. But yet at the same time, if nothing happens, then you're only risking that 20 cent outlay. And so it allows you this opportunity to make some pretty big bets, or at least a big payoff bet, that if crude oil made that move, you can really get make a lot of money. And at the same time, your risk is defined to a very small, modest amount. And that is really sort of one of the ways that you want to buy right tail upside, because you don't want to have a big, heavy carry where you're theta burning a huge amount of option premium, and it costs you a lot of money for a trade that might not work, right? Because if we look at it from a balance of probabilities, Eric, I mean, there's probably, I think the market is assigning somewhere like a 5% probability that we're going to go to 175 on the upside. So just based upon market pricing, there's a 95% chance that this option is not going to pay off and it's going to expire, right? And so you want to have a very low cost to it. And that way, if that really did arise and that big move did happen, you can make some really big money.
Well, Patrick, all three of these trade strategies are excellent food for thought. I will be considering them, as I'm sure will be many of our listeners. And folks, if you have enjoyed Patrick's analysis of option strategies, be sure to sign up for a free trial of Big Picture Trading so that you can get more of them every single day of the week with Patrick's webinars. You find the information on pages 11 and 12 of the chart deck, or you can just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.